You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you for tuning in today. I got a really special guest lined up for you, and we're going to be talking about underwriting. But before we get into that, do me a favor. If you're listening to this show and you haven't hit the subscribe button, go ahead and subscribe right now on YouTube, iTunes, Spotify, wherever you're watching us at. Hit the subscribe button. And, you know, if I'm adding value to you by bringing on these rockstar guests, go ahead and leave us a review, because that's how we keep bringing on rockstar guests like the guy we have today. But housekeeping is out the way. Today, our guest is Rob Beardsley. He oversees acquisitions and capital markets for Lone Star Capital, and has acquired over $100 million worth of multifamily real estate. You know, that's amazing, man, that you've done even that, though. He has several thousand opportunities. He has evaluated several thousand opportunities of his proprietary underwriting models, and published the #1 book on multifamily underwriting, which is called The Definitive Guide to Underwriting Multifamily Acquisitions. And I actually read that book, man, and awesome book. You know, if you guys haven't checked it out, it's on Amazon, and I will include that in the show notes. Rob has also written over 50 articles about underwriting, deal structures, capital markets, and he's also the host of Capital Spotlight podcast. So, man, appreciate you coming on the show today. You know, that was a really quick overview of, you know, what you're doing right now. But yeah, I always like to dig into, you know, how did you really get your start into, you know, commercial real estate?
Yeah, so it's been an interesting path for me. I grew up in a real estate family, but I grew up in Silicon Valley as well, and my parents pushed me towards tech. So growing up around me, I saw, you know, a lot of technology startups be very successful, and obviously you've got the tech giants, and you know, everybody's dream was to, you know, make it big, start a startup, and you know, sell it or go public and make their money. And so I went to college actually for computer science, and you know, studying that, but I just was always fascinated by investing. I loved capital allocation and you know, compound interest and thinking long term like that. And so that just circled me back all the way to real estate. And you know, coming back to real estate with my family's background, it turned out that I had really learned growing up by being around my parents. I learned more than I really thought. I just had soaked up just all this information from them, just taking phone calls. Both of them worked from home, so I was just constantly hearing them do deals and talk business. So in college, I actually just started networking, reading everything I could, learning things online, you know, on the Bigger Pockets forums and things like that. Yeah. And, you know, up to that point, my family had really only done residential, single family, you know, sales, development, rehabs. And, you know, I started looking into multifamily, and it just felt like such a right fit, and just the next evolution, as so many people go through that evolution from single family to multifamily. And, you know, it took a young kid like me who didn't know any better to say, no, we can do this. Let's dive in. And, you know, first I started working with my parents. We were, you know, working on some deals together. And then I realized that they were still bogged down with their main business, and I had to branch out. So I met my business partner at a conference, and we founded Lone Star Capital almost 3 years ago. And it's been great ever since.
Yeah, that's awesome, man. It's very cool to hear that your family was doing real estate and you was kind of always around it. And but something that you really touched on there, man, and I want the listeners to really capture that, is he was at a networking event, and that's where he met his business partner. So you got to get out there and network. You can't, you know, think you're going to be in this game and not be talking to people. So get out there and talk to people, and that's how you find your potential business partner. So that's awesome, man.
Yeah, it's really you know, interesting story. I mean, not many people, you know, think of that as really a viable way to meet somebody who you could actually work with so closely, right? You know, we're all just so busy kind of networking fast and trading business cards and on to the next. But, you know, really some good advice I heard is whenever you go to a conference, you're always looking to learn that one thing that could change your life or business, or meet that one person that could change your life or business.
Right. No, that's a very good point. Obviously, COVID has put a wrench in a lot of going to networking events. But what advice would you give to listeners around just kind of networking right now to try to find those potential business partners? Like, what would you recommend?
Yeah, so it's been a really interesting time because obviously we're all at home.
Yeah.
So people have more time. They're answering their cell phone, and we're on the phone. We're having phone calls, and so I think people are generally open to speaking on the phone anyway. But I found that it's been easier to just make a cold email introduction and say, hey, how about we jump on a phone call this week? And that's been working really well. So I've been trying to keep my networking going, even though I'm at home, by just being out there, kind of doing my homework, finding out who's worth talking to, who do I want to meet next, and just reaching out.
Yeah. Gotcha. All right, man. So let's start talking about underwriting. First off, there are some people listening to this show that you have no clue what we're talking about when we say underwriting. So give us a overview of what underwriting is.
Yeah. So underwriting from the perspective of multifamily acquisitions is really taking the financial information and your operating assumptions and inputting that all into a financial analysis to come up with a valuation. And you can look at it two ways, right? You could look at it, you're either coming up with a valuation, meaning what price should I pay, or you're plugging in a price and you're kicking out what return that would give you. So, both, it's the same thing, but it's just how you want to look at it. You're either saying, okay, these are the returns I want, and then you're solving for a price, or you're plugging in a price and saying, okay, these are the returns I'm going to get, and it's a yes/no decision.
Yeah. And it's just like anything else. If you want to get good at it, you got to do it a lot to really understand, what you're doing there. And Rob, man, he's underwritten over 1,000, multifamily properties. So, we can all agree that this guy's a beast at it. So, man, tell us what is one of the first things we should be looking for when we find an opportunity that we potentially want to purchase? What's the first thing should we look for?
Well, it's all about basis, right? And what that means is what you're getting for what you're paying, right? You want to get value. And so basis means different things to different people, but a lot of people are, price per pound driven, and they're just really focused on price per door, price per square foot, and things like that, which I think that's one of the first things you should look at and just kind of sanity check the pricing and say, okay, if you know a market pretty well, you should start to get a general understanding of what the typical expense ratios are, what the typical rents are for this property. And then once you know the price per door, you can use those couple metrics to kind of put it together and say, well, does that make sense? But next, obviously, you just need the T12 and the rent roll at trailing 12-month financial statement, that is with income and expenses broken out, and then the rent roll just to show you all the leased rents and get some more granular information there as well. But also you just get your physical occupancy that day. So the rent roll is a snapshot in time. It just shows information for just a day, whereas a T12 shows you 12 months of information. So both are important. But the first step is really to look at the in-place numbers before you start making future projections and saying, well, we're going to raise rents and we're going to renovate and sell at a low cap rate or high cap rate. You really just want to see what you're getting in place, and that goes back to the basis, or what you're paying for, because you want to know, even if it's a value add deal and you're going to raise rents, your going in cap rate always matters, and you still need to know that you're going in at a competitive price.
Right. And the best way to assess if you're being competitive in your price is understanding the market cap rates and seeing what other people are paying in the marketplace. Correct?
Yeah, absolutely. And you can go in at a lower cap rate or a compressed cap rate because it's a value add, right? That's a very, very common thing that people see, right? If the market cap rate is 5.5, you might end up paying a 5 because the occupancy is a little lower at the property, or because the rents are a little lower, right? Which means it's compressed 5 versus 5.5. But your goal is, when you take on a value add project is not that you're a compressed 5 cap once you implement your value add, that it gets you to the market cap rate of 5.5, because then you did all that work and took on that risk for no benefit. I could have just bought maybe a newer, nicer building at a 5.5 and called it a day. Yep. So you really need to, this is something that people don't focus enough on, but you really need to see when you take on a value add risk, you want to see at least 100 basis points of premium on your return on cost, or the cap rate that you end up at after your value add, over the market. So if we're talking about getting in at a 5, market is 5.5. Yep. I want to see you stabilize out at a 6.5.
Gotcha. So just to reiterate what you just said, if I'm looking at an opportunity and I'm buying it at a 5 cap, which is compressed cap rate, and the rents have not been pushed for whatever reason, hasn't been any upgrades done to the units. I upgraded units, and now the income increases, which helps the cap rate increase, is what you're saying, correct?
Yeah, exactly.
Okay, gotcha. All right, now, so when you're looking at an underwriting model, you have your underwriting model, right? That's on your website, right?
Yep.
Yeah. So it's a custom made website for you. That's custom made underwriting model for you that are listening, and you can go to his website and download it for free and start plugging deals into it. But tell us, man, why did you decide to create a underwriting model? Because, man, I've looked at a lot of them. There's a ton of gurus out there that have their own models, and everybody has their reason why they think theirs is the best. But you said, well, hey, I'm just gonna do my own, which is, I think it's crazy, man. So what made you want to do that?
Yeah, so it's an interesting story, because when I first started out, I also felt that it would have been kind of a waste of time to build my own, because I'm just recreating the wheel, right? We don't build our own cars, so why would I make my own model, right? Perfectly good model already exists out there. I just need to download it, right? And get on with it. So, but in the end, it was actually one of the best decisions I'd ever made, because the process of actually building it was extremely instructional to me, right? I learned so much more about the formulas and the numbers and how everything works together. So that's number one, is just how much I learned through that process. Yeah. And then number two, obviously I was able to customize it to work just the way I wanted it to. Yeah. Which is really important as you're working with a model. You can get the same effect when you are working with another model. You just have to work with it a bunch to get familiar with it. But either you build your own or work with another. Once you get familiar with it, you can really start to trust it. And the added benefit for me building it is I really know how every single calculation works, right? Yeah. If you didn't build it, or if you didn't track every single formula, you may not know exactly how certain things are calculated, which may make you more aggressive or more conservative than you may want to be or know you are to be. So those are the benefits, and I think they've been well worth it.
Yeah. I mean, that's a very good point. And you almost got me wanting to get out there and try to put one together, but I don't even know if I got the time. I know it takes, man, a ton of hours to put something together that's complex as these underwriting models are. But you said something really good there. Really understanding how the model works is the biggest factor. And the only way to do that is, like I was saying earlier, is underwriting a crap load of deals. Then you really know, okay, how is this thing really kicking out IRR and cash on cash returns, and comparing it with other models just to kind of see, because I read that in your book, man. You said that you can have two models, right? And they could both kick out two different IRRs, and it's almost like, well, how the heck is that possible if we put the same numbers into the model, right?
Exactly. And you brought up the perfect point that I wanted to talk about next, which is, if I'm underwriting a deal with a brand new model that I've never worked with before, and it kicks out a 15% IRR, I have no idea what that means. Yeah. Because I just can't trust it. And there's just little wrinkles that can affect that number. And so the number itself becomes less important. And what's more important is that you've underwritten so many deals. And if you've underwritten 100 deals through this one model, and if most of the deals are coming in at, a 7, 9, 10 IRR, but then all of a sudden one comes in at 15, that deal is special and it's better than the others. And so maybe for you, it was a 15 that was special, but maybe in somebody else's model that's set up to be a little more aggressive in certain ways, that might be a 20. And, both of you are going to think it's a good deal. Right. So it's really okay. What we were looking for is the top 1% of deals that stand out based on our metrics.
Yeah. That's a very, very good point. So what market specifically are you guys focusing on right now?
So as you may know, we're big in Texas. We're looking at all the major cities and secondary, tertiary markets throughout Texas. We're very heavily focused on Houston, and nothing's really changed there. We have been branching out to nearby states like Oklahoma, New Mexico, Arizona, Arkansas. So we're trying to kind of grow regionally, but we want to stay focused and we want to build out our base of operations so we can have some operational scale. So those are the markets we're focused on, and we're looking for both core plus and value add opportunities. So on the core plus side, we're seeking better assets in better locations that we can hold for longer term and get a nice positive cash flow. And then on the value add side, we're really looking for something that's broken, whether it's broken management, broken real estate, broken capital structure, and we can go in, buy it, fix it, refinance or sell it.
Yeah. So let's take a moment to talk about your market selection. So when you're looking at you got your primary markets, obviously everybody wants to be there. There's jobs there, population there. So those are going to have very low cap rates. And then as you start going to your secondary and tertiary markets, the cap rate is going to change. But as far as your underwriting guidelines, like how do you change your underwriting guidelines when you start getting in, those secondary and tertiary markets?
Yeah, so we typically don't love to project rent growth in any case, but we understand that in a very hot market, like you said, like a Phoenix, Denver, Dallas, you really need to project some rent growth in order to be competitive with the market, because all your competitors are underwriting to rent growth. And so they're willing to pay up on that lower cap rate going in because they know that cap rate will increase over time as rents just keep growing from all those positive fundamentals, like you said, job growth and things like that. So, unless we're in one of those really growth markets like a Dallas or a Denver, we are going to keep our rent growth at 2%. But if we're going to be somewhere like that, we'll probably use 3% and keep our expense growth at 2%. So we're actually seeing a net positive growth of 1%, right?
Yeah.
But in places that are more, call it standard markets for us, our typical way to go is just 2% rent growth, 2% expense growth. So we're just really expecting inflation to happen. And then when we're in really, I don't want to say bad markets, but really small markets, higher risk, really no growth fundamentals, we're probably going to just use 0 on the rent growth and still keep the 2% expense growth.
Yeah. So, I mean, if the rent is not growing in a third tier market and the expenses are continuing to grow, then that almost makes it a deal killer, right?
Yeah, you're making the deal really tough to pencil. So it's just it's forcing you to really have a good deal to make it worth going to that small, tougher market. And the other thing I would make a note of is, it just makes you also want to make sure that you have a strong exit, because you don't have marginal benefit of holding the property for longer, right? Because as you hold, your expenses are potentially going up, but your rents aren't probably going up quite as fast. And so it's not like when you buy into New York City or, one of these growth markets that we're talking about, that, the longer you hold, just the better it gets. So you really need to be cognizant of your ability to exit in one of these, lower growth or, smaller markets.
Yeah. So, I mean, essentially, what he's saying, guys, is if you're buying in a smaller market, say 100,000 or less with the population, then you should go into your underwriting understanding that, hey, man, we want to be out of this thing in 2 to 3 years. A lot of times it's going to be mom and pop owners that's in these kind of marketplaces, and You're going to be getting a bridge loan probably to take these deals down, and you want to get out of there as fast as possible. Make your money and go, right?
Right. So have a real compelling opportunity that makes sense to, go in there, raise the profit, raise revenue, and then, sell at a higher price.
Yeah. So let's jump back into the underwriting model. When you're underwriting your deal, income wise, what do you look at when you're looking at the income? What do you count, and what do you say, hey, I don't really count that as real income for the property?
That's an interesting question. So, in general, we're going to factor in all income, obviously starting with the rents, and then looking at RUBS, so utility bill backs, and then there's obviously a bunch of other incomes such as administration fees, pet rent, pet fees, and late fees, and things like that. Yeah. So, I wouldn't say that we're necessarily discounting too much of the income line items. I'm trying to give you an example of where we actually do that, and don't count it quite as much.
Well,
I would say
not the bill back system, but like if you got laundry or something like that, will you count that since it's more steady, or maybe something like late fees? Like that's nothing that you can really guarantee every month. Like, is that one of the things that you don't count as your income? Like, how do you look at that?
So that's a good question. So the right answer there is, what you want to look at is you want to look at a longer period of time, the longest period of time possible if you can. But typically when you're looking at a deal, they're only providing that T12 that we talked about, so the trailing 12 months. Yeah. So you want to look at a longer period of time because like you're getting at the right point, which is that other income items like laundry or late fees are more cyclical and they're more noisy. So if you're just going to underwrite to T3, which that's what a lot of people do when they underwrite income, they're just looking at the most recent. They want to capture, hopefully what is the most positive recent results. Yeah. You might be under or overstating other income items just based on if it's the summer, if it's the winter. And so looking at full 12 months of data for late fees will smoothen out the noise and really give you a better sense of what you can expect for late fees across the 12 months. And that's true for pretty much all other income. Yeah. So that is a good point, that, for vacancy, we're fine doing T3 because vacancy is just, we want the most up-to-date numbers on the vacancy, right? So we're fine using a T3, which means just the trailing 3 months of information. Right. But for other income, we always use the T12 numbers. Yeah. That's very, very good points. Very good points. Now let's transition to the expenses side of it. So when you're underwriting the expenses, what are you looking at first off to see if there's anything out of place? Yeah. So going back to just doing a full underwriting of the in-place numbers. Yeah. That's exactly what we're looking for, is just we want to know what the in-place numbers look like and then compare them to what our typical baseline assumptions are. And so we want to see where they're high and then why are they high, right? Because we don't want to just assume that we can lower their expenses right off the bat. Yeah. So we want to understand, what is it that's driving their above market payroll, right? If their payroll's at $1,800 per unit and we think it should be $1,200 per unit, that's a huge difference, and we need to understand what's driving that. Similarly, contract services. Yeah, they may have, a big security contract that is costing them a lot of money every month, and for us, we think, well, can we do away with the security? Can we just install a camera system and reduce our expenses that way? So yeah, expenses are a really interesting place to think creatively and look and see where you can bring down the expenses. But oftentimes what I actually see is we're bring up expenses. Yeah. So I would say it's, probably more than 50% of the time, the expenses look low to us on the T12 or the seller's historical financials. Yeah. And we're bringing them up to our averages. Yeah. Now, I guess in the Texas market, that's what you're most familiar with. What is typical of a 100+ unit, community out there as far as the expense load? Percentage wise? Right. Good question. So I'll break it down by class of property and kind of the age. So when you see a deal that is, 1970s and older, and it's likely on a boiler chiller system and has higher repairs and maintenance because it's also older, you're going to see anywhere from 55 to 60% expense ratio, right? That's actually, sounds high, but it is possible. And you see that often for the older properties. Now, when you get into the 80s stuff and into the 90s, depending on how high the rents are, so depending on location, you're going to be somewhere between, I'd say 45 and 55. So it gets to be a bigger range, but you could say just on average 50%. And then we see, and another thing about Texas is the taxes are a big one, and the insurance is a big one, right? If you're in a flood zone, or if there's some other risk on the insurance side, your insurance per door might be, very high and contribute to a higher expense ratio. So, and same with taxes. So even on Class A stuff, which has high rents, you could still potentially see anywhere from a 40 to 50% expense ratio, just depending on how those expenses shake out. So unfortunately, and I don't know if this is unique to Texas, my guess is that everywhere has got these nuances, but unfortunately, I don't think you can just automatically slap on this one number and kind of shortcut your way through. But with that being said, we definitely do focus on that number, and I'm always looking at it to make sure, does this look right?
Right. Now, you mentioned something else very good when you think about underwriting in your book, and that was not using the current tax rate, the tax amount that's on the T12, and using the new purchase price tax rate. So talk about that for a minute, because that's very important.
Yeah. So, I mean, especially in Texas, a lot of deals could look really attractive if you underwrote them at the seller's tax basis or the in-place tax amount. But unfortunately, taxes go up every year, and whether the county is sales chasing or not, which means they're looking for sales to then reassess higher to a new higher value. That's the reality. And so we always are aware of how the taxes may change upon this sale, and us beginning to own it, especially if we're doing a value add, because they are aware of value add, and they're looking for people that are raising rents, because if you're raising revenue, they want to raise, they want to get their piece of it. So that, we just have to be aware of that, and we utilize our consultants. And, to your point about in the note in the book, when we're underwriting a deal, we're not looking at the cap rate based on what the seller's paying, because we know that tax basis is not ours. So I want to know what the tax rate is, the cap rate is, based on what we're going to be paying for taxes, because that really shows me a true indication of value and showing me, okay, yes, when I take over this deal, I'm going to be at a 5% cap rate.
Yeah. No, that's very, very good points there. Now, there's some guys that's listening to this that's, syndicators or aspiring to be syndicators. So how does your underwriting help them evaluate, the returns, projected returns? And let's talk about that for a minute.
Yeah. So, I mean, I appreciate you, speaking highly of the model, but I do recommend everybody go out and download it and play with it. And if you don't end up loving it, take some of the things you like from it, and, take some things that you like from somebody else's and build your own. And, grow and learn from there. But yeah, either way, you need to, if you're not already, you need to start underwriting deals, every day or every week, and really getting yourself familiar with the inputs and how they relate to the outputs. Like you mentioned, the actual returns. And once you've done that enough, you can really start kind of figuring out what your return targets are. And we've gone through that process, and just by talking to investors and looking at the deals from our perspective, and we've assigned return criteria based on the property's location and business plan and asset quality. We really know what return we want for that, and which helps us better price our deals, which then helps us make more competitive offers, right? Because we're just more confident in what we're offering when we're coming in. No, that's very, very good points there. Now let's take a moment and talk about obviously, most people that's buying property, they're going to be using some form of debt. They're not going to pay cash unless they're
freaking gazillionaires. But, so how do you calculate or factor in different debt and I guess current interest rates? How does all that play in the underwriting?
Yeah. So, great question. So we have, as part of our acquisition assumptions, we have kind of a full debt input area. And so, depending on what the deal looks like in terms of if it's new debt or a loan assumption, we look at deals in every strategy, and we need to be able to model it appropriately. So we factor in, obviously, like you said, the interest rate, the amortization schedule, how many years of interest only, the fees. And so that all gets baked into the deal. And another interesting thing that I actually just recently added to the model, which, definitely overdue. It's funny, whenever I finish updating my model and it goes through a new update, I look at it and say, oh, this looks so much better. I'm so happy. And then I look back at the old version. I think, wow, I can't believe I was, proud of this and looking at this. But what's funny is then I go through that period again, and the one I was proud of again becomes the old one that I go look back on and say, geez, that was missing so many things. Right. Right. But anyway, so I just updated it with a loan quote matrix, which really helps us evaluate different debt options. Yeah. And so we can put them side by side and say, okay, well, this is what the loan looks like from Fannie Mae. This is what it looks like from Freddie Mac, or this is a bridge loan. And we can see how they all work in terms of passing certain underwriting metrics from a lender's perspective, right? And so that's another benefit of underwriting deals and focusing on the metrics, is you can really get a better sense of how the lender's looking at the deal from a LTV, DSCR, which is debt service coverage ratio, and debt yield standpoint. So we're heavily focused on that to make sure that our loan makes sense, because when we're underwriting a deal and we might be assuming 75 or 80% LTV, and we make our offer based on that. But if I wasn't paying attention, maybe when I actually go to the bank and want to get the loan, they're only willing to give me 70% because I missed certain metrics that the deal actually wasn't passing through. So and then my offer might not be valid, because once it's only 70%, I might not like the deal at the same price. Right.
No, that's very, very good points, man. Very good points. Is there anything that I haven't asked you around underwriting that my listeners may should be thinking about when looking at deals?
I mean, there's so much there still, right? We could talk about terminal valuation, and we could talk about modeling in refinances or partnership structures and how to model in a waterfall, right? And set up a deal.
Let's talk about the terminal cap rate, because that's very, very important. Let's talk about that for a minute.
Yeah, sure. So I mean, we were talking about it before we started recording. The terminal cap rate, for better or for worse, really has such a big impact on your returns, right? Because especially on a value add deal, so much of the returns are generated on the back end when you actually sell. Yeah. And that sale is really based on your valuation of, basically the price you're projecting to sell at. So that's right. So people look at the exit cap rate and they just see it as a number or a percentage, and they think, oh, well, the difference between 6 and 6.5 is not that big. But that's, that could be $1 million on your sale. Yeah. So, you really need to look and, not only be smart with what exit cap rate you're using, but also just sanity check it and look at, in your model, if I use a 6% exit cap rate, what does that translate to in an actually forecasted sale price 5 years down the road? And you can look at that and say, okay, well, does that make sense? Right.
So, what kind of bibs are you putting on your entry cap as far as, projecting your exit cap? I hear some people say, 10 percentage points, and, other people is way higher than that. So, where are you guys at?
So we are less focused on the spread between what we're buying and what we're selling, and more focused on what the market cap rate is today. Yeah. So because, like we talked about earlier, a compressed cap rate going in is going to throw off that ratio. Yeah. So if I know, but basically what we're looking at is, like you said earlier, if we're in the market, talking to brokers, making offers, we know what the cap rate is in the market. Yeah. And so what we can do is we can say the market cap rate is 5.5%. And we're going to typically exit 50 basis points wide of that. So at a 6% cap rate. Yeah.
Yeah. Gotcha. Um, Now, you mentioned something about waterfall structures, and somebody might not know what waterfall structure means. So explain that real quick.
Yeah. So a waterfall is the most simplest way to really calculate how profits flow through the partnership. So in the partnership, you're typically going to have, the general partner or the sponsor, and then at least one LP.
Yeah.
And you can structure a deal a million ways, and the waterfall really is the way to calculate and reflect how those profits flow. So, for example, the most typical waterfall would be the limited partner investors would receive a preferred return. So, if you think about the waterfall, first, the water is going to flow into the preferred return bucket of 8%, and that bucket's going to fill up to 8% first.
Yep.
No, nothing goes anywhere else. Once the investors have received their 8%, then that bucket might be full and it'll start overflowing into the next bucket, which now allows the sponsor to promote. And you can have multiple tiers, right? And it can flow into another tier where the sponsor gets a higher promote as the returns get bigger. So there's like I said, there's a million ways to structure the deal, and the waterfall is the clearest way to calculate it.
Yeah. And for the investors that's kind of listening in right now, it's very important to pay attention to how the waterfall structure is put together, because this is where you want to see the alignment of interest to make sure that the sponsor or syndicator is taking care of you and not just his own self, because they can feed you to death if they want to, with all the asset management fees, acquisition fees, and management fees. It's just a lot of ways for them to make money. So and you mentioned something about that in the book too, man, about just the kind of fee structure. So just take a moment and just kind of mention that to the listeners so they can understand what kind of fees are associated with a syndication.
Yeah, there's a lot. So, and they're not always standard. So you need to, number one, get out there, network with a lot of people, and start evaluating a lot of. If you're a passive investor, start evaluating a lot of sponsored deals and see what the fee structure and the promote structure looks like, and get a good sense. Talk to other investors and get a good sense of what market is. Obviously, good investors want to pay fees. They want to keep their sponsors happy, and they want them to bring them deals. But with that being said, nobody wants to pay more than market.
Right.
So you want to be aware of what's market in terms of acquisition fee, asset management fee, disposition fee, and you got to be smart, and you have to look into those hidden fees. Right, there might be some things that might not be mentioned, but they're material to the deal. Yeah.
Very, very important. Very important. And obviously, we're still dealing with COVID. So when the deals are coming across your desk, how are you underwriting it with not with the uncertainty that's going on with COVID, and how that's going to all play out in the coming months ahead?
So we're still very optimistic about the long term, right? I think most of us still believe in the long term.
Yeah.
And so what we're doing is we're adjusting the short term, right? And so typically for the first 12 to 24 months, we're stressing our going in vacancy rate. So assuming that we're going to have either higher vacancy or higher collection loss, and we're also assuming no rent growth for the initial period, and then and we're assuming a longer stabilization. So if we have a value add business plan, we want to renovate units, we're assuming that's going to take longer, because we're probably going to put that on pause for now and then pick it up. So we're extending that timeline, and then also in some cases we are extending our projected hold period because that, number one, is more conservative, because we're just allotting more time to implement our business plan and go through that process. And then number two, a longer hold period usually brings your IRR down slightly, because you're spreading out that pop in value over a longer period.
Yeah. No, that's good. That's good. All right, man. So let's go ahead and segue to the last segment of the show. It's our lightning round, and just got about 5 questions for you. Ready?
Yep.
All right. So what's the best advice you ever been given?
Wow. Best advice you've ever been given. I mean, I'd say just, that you can do it, and everything's out there for you. You just have to be the one to make it happen.
Absolutely. 100%. What's the best book you've ever read?
The best book I ever read. Well, that's interesting. I love reading. I read so many books. I'll say, I mean, Think and Grow Rich is a great one. That's kind of similar to the first question, right? Just about motivation and, believing in yourself, things like that. So I'll put that one out. That's a classic.
Yeah. Great book. What are some rituals you're doing right now to make you a better investor or a person in general?
That's a great question. I love routines, rituals. And so what I'll say is I've got my journal here. And so every morning I try to, I write what I'm grateful for. I write my goals out, and then I write what I need to, the big few things I need to get done that day that'll really move me forward towards those goals. So I like to, really roll that all in together. And in terms of being a better investor, I just read as much as I can and talk to people as much as I can. So it's a constant, I mean, that's the best part about the investment business is you are never finished learning, right? Because you're faced with new challenges, COVID, for example, every day. So I love reading other people's memos. And as you might know, I write my own articles and things like that about, my thoughts in the market. And I love how that sparks conversations in terms of agreements or disagreements. So, so really that's a great thing about investing.
Yeah, absolutely. What is one thing you're doing right now to help you improve your business?
Well, kind of like how we talked before, networking is still crucial, and it always has and always will be. And so that's definitely something I'm working on, is just getting on the phone with more people, reaching out to more people, trying to build our relationships so that, when things are more opened up and we are able to find that right deal, we've got people ready to go that we can partner with and make it happen.
Absolutely. Last question for you. If you can give your younger self one tip in regards to investing, what would that be?
It would be to, network fast, learn fast, go out there fast, but move slow, right? Make decisions slowly, consult with mentors, do your due diligence. And then, when it's the right time, pull the trigger.
Man, that's great. That's great. All right, Rob, man, we at the end of the show here. We really appreciate you coming on this the show today, and you added a ton of value. How can my listeners get in touch with you?
Yeah, so you can find more about us at lonestarcapgroup.com, and there on the homepage you can click the link to sign up for my newsletter to get the underwriting model package sent to you with obviously the model and some other helpful guides and tutorials. And if you want to reach out to me directly, you can do so by emailing rob@lonestarcapgroup.com.
Fantastic, man. We appreciate you coming on the show today.
Thanks for having me.
Yes, sir.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.